Welcome back to the channel. Today, we're diving into the reasons behind the recent crash in the Indian stock market and what the future holds for investors. Now, if you've been following the markets at all, you know things haven't been looking too hot lately, with the Sensex and Nifty down significantly. But before you panic, sell everything and bury your money in the backyard, let's break down exactly what's driving this downturn, what it means for you, and most importantly, what moves you can make to protect and even grow your investments during this time. It's easy to get caught up in the headlines and doom and gloom predictions, but remember, knowledge is power. By understanding the factors at play, you can make informed decisions and potentially even come out ahead. We'll be looking at things like foreign investment trends, government policies, global economic factors, and more. I'm also going to give you my honest predictions for the future of the Indian stock market, so make sure you stick around until the end. This is important stuff, guys, so let's get right into it. So, one of the biggest factors driving this market downturn is the massive outflow of foreign investments. We're talking about foreign institutional investors, or FIIs, pulling out over 1.12 lakh crore rupees in just the first 2 months of 2025 alone. That's a huge amount of money leaving the Indian market. Why are they doing this? Well, a lot of it has to do with what's happening in the US. The US Treasury yields are rising, and the US dollar is strengthening, making investments in the US more attractive compared to emerging markets like India. It's like choosing between a safe, reliable investment that's suddenly paying a higher interest rate and a riskier investment with potentially higher returns, but also a higher chance of losing money. Many FIIs are choosing the safer bet right now, and that's putting downward pressure on the Indian market. And as if FII outflows weren't enough, we've also got the Indian Rupee hitting record lows against the US dollar. We're talking 86.5825 rupees to $1, which is a big deal. This depreciation is being fueled by a few things. The strong dollar, of course, but also those massive foreign investor outflows we just talked about, and the Reserve Bank of India's limited intervention in the currency market. This falling rupee creates a whole bunch of problems. It makes imports more expensive, which can lead to inflation, and it also hurts companies that rely heavily on imports for their operations. Plus, it makes investing in India less attractive to foreign investors because their returns get eaten away when they convert their rupees back into dollars. It's a vicious cycle. Now, let's talk about mid and small cap stocks. These were the darlings of the market for a while, with some crazy rallies and sky-high valuations. The Nifty Midcap Index's price-to-earnings ratio, for example, was a whopping 58% higher than the Nifty 50. Investors were pouring money into these stocks, hoping to ride the wave and make a quick buck. But, as with any bubble, what goes up must come down. These inflated valuations weren't sustainable in the long run, and eventually, investors started taking profits, leading to a sharp correction in these segments. It's a classic case of irrational exuberance followed by a dose of reality. And just when you thought it couldn't get any worse, the government decided to make some policy changes that really spooked investors. They increased the long-term capital gains tax from 10% to 12.5% and the short-term capital gains tax from 15% to a whopping 20%. Now I'm all for paying taxes, but these hikes were seen as very unfriendly to investors. Higher taxes mean lower profits, and that's never a good thing for market sentiment. These tax hikes contributed to the sell-off we've been seeing as both domestic and foreign investors headed for the exits. It's a reminder that government policies can have a huge impact on the market. Chapter 5. Oil prices, the global headache hits home. As if all of that wasn't enough, we've also got rising crude oil prices to contend with. Brent crude has been hovering around $81 per barrel, and for a major oil importer like India, that's a big problem. Higher oil prices mean higher costs for businesses, which can lead to inflation. It also widens the trade deficit, as India has to shell out more rupees to buy the same amount of oil. This puts further pressure on the rupee and creates a drag on the economy, which obviously doesn't inspire confidence in investors. Chapter 6. Global trade tensions, uncertainty looms large. And finally, we can't forget about the elephant in the room, global trade tensions. The threat of new US tariffs has made everyone nervous, especially in sectors like information technology and automotive, which are heavily reliant on international trade. Remember when the NSE Nifty 50 dropped 0.77% in a single day? Yeah, that was partly due to fears of those tariffs becoming a reality. When the global trade environment is uncertain, businesses hold back on investments, and investors get skittish. It's a recipe for market volatility. Chapter 7. The Gold Rush. Is this the new safe haven? So, with all this negativity surrounding the stock market, where are Indian investors putting their money? Well, many are turning to gold, the classic safe haven asset. We've seen record inflows into gold ETFs as investors seek stability amidst the chaos. Gold is seen as a hedge against inflation and economic uncertainty, so it's no surprise that it's become the go-to investment for many during these turbulent times. It'll be interesting to see if this trend continues. What's next for the Indian stock market? So, what can we expect moving forward? The government is taking measures to stabilize the market, but as retail investors, it's crucial to stay informed and make strategic decisions. Don't panic and sell everything based on fear. Instead, take a deep breath and assess your investment goals and risk tolerance. This downturn could present some buying opportunities for those who are patient and strategic. Remember, the market moves in cycles, and what goes down often comes back up. The key is to stay informed, stay disciplined, and don't make emotional decisions. Thanks for watching, and don't forget to like, share, and subscribe for more updates.